Record
this.
button.
Yeah.
There you go.
Cool. Sounds great.
Excellent. Good morning, everyone. And thank you for those that are punctuating in early and got to listen to our lovely chat about what we got up to on the weekend. So welcome to our LendAD Small Business Accounting webinar series with who is now classed in our organisation, definitely, and I'm going to need to carry this tagline all the way through, the guru of small business accounting, Davey Mack from Box Advisory Services. Morning, Davey.
Morning. How is everyone going?
Look, I think today is a really nice turnout, a lot more than what we actually expected, and which is obviously a great reflection on you and the word on the street from the last webinar, but certainly that the content today is really topical and really important to not just our brokers, but to their clients as well. So are you ready to get started today?
Yes, it's end of financial year, and what that means for accountants like myself, it means that we don't have much work to do, so we can chat about how ways to save tax.
Excellent, and that's what our brokers love to hear about. So we're going to start off, we're going to touch on for the first part around the incentives, the write-offs, and basically those tax minimisation strategies that are out there. So over to you. Let's start with, say, temporary expensing.
Yeah, sounds good. So the federal budget actually did have a bit of chat about this. And what they did was they extended it to 2023. Temporary expensing, in my nice fancy words, is just a no limit asset write-off. So it's exactly what it was back then. Back then, you'd only be able to write off an asset under 150K. So back then is 6th of October 2020. After 6th of October 2020, you can pretty much claim anything that is a second-hand asset or anything that's a new asset, as long as that asset is available for use. So the good thing about the federal budget is that it's extended it to 2023. And the reason, what I think is, one, it was a really good concession already. So why not just extend it? But also two, there's a lot of farmers out there, or a lot of small businesses that are struggling to get that asset before 30 June. And they're just giving them more time because of COVID and the issues they are having with COVID with delayed stock. So right now I have clients that are trying to buy a car, but they can't even get the car sourced, or they can't even find a dealer to even provide them the car. So that's what temporary expensing is. Fancy word of it is the no limit asset write-off, which basically means that you can claim it up front. The differences with claiming it up front is that you got to understand is that there is a difference between leasing versus borrowing the money and buying as well. So when a client comes in, they want to borrow the money to buy an asset, they can claim the asset right up front. So if you're spending about $60,000 on a car, for example, you can claim the car up front. But if you're leasing it, you only get to claim it on a monthly basis or whenever you make the actual monthly payments. So you don't get the whole full expensing or the full asset write-off. Yeah.
So Davey, I guess to put that into, what does that mean for our brokers, and why is it important for them to understand one about the extension and the 150K, but also that leases versus borrowing? How do our brokers put that into everyday transactions or conversations?
Well, yeah, the main thing is to you're not a tax agent, but you can also just give them some general advice or general information, or get them to speak to an accountant to work out when they can actually claim it. It's also good to provide that information to accountant. Brokers and accountants need to speak. It's really important. We have brokers on our books, and brokers always send us the amortization schedule, the lease payments, the lease report, as well as the summary of the contract if they have that in place. And it's really, really important for that. So it's good that the broker also then speaks to the accountant and advises the accountant the differences between leasing versus, borrowing the money to buy the asset.
Yeah, excellent. Cool. So the next one, which is really important, and again, this can get quite complicated. So we'll try and keep some of these. Obviously, it's all really important, which is why we want to bring them up today. But talk to us about losses carried backwards.
Yeah, so losses carried backwards is actually quite confusing. I tried to explain it to a few small businesses before and struggled. I think I made it even worse for them. So it's actually quite confusing for accountants as well. So if you're an accountant that doesn't really know how losses carried backwards work, you'll get confused as well. But basically, In simple terms, if you paid taxes in 2019, 2018, or 2020, because you made a profit, if in 2021 or 2022 or 2023, you've made a loss, you can, instead of carrying forward that loss and claiming the taxes in the next years ahead, you can claim it backwards instead. So meaning that you pay taxes previously, you can get the government to pay you back those taxes.
Okay.
Sounds complex, hey? So best to speak to an accountant or speak to someone like us at Box Advisory Services. We can work out, if you're entitled to those losses carried backwards.
Yeah, perfect. All right. So, and there's been heaps of talk about this. We're all reading snapshots, bits and pieces. But again, most of our brokers, obviously, as you know, Davey, we transact commercial finance at Lend, but we have a lot of brokers who operate across both, so consumer and commercial. So low and middle income tax offset, that's going to stay in place for another year. Is that right?
Yeah, basically. So what people would have noticed is that the tax refunds have been a bit more healthier in the last year or so, probably the last 2 years. And that was because of this low and medium income tax offset. So if you earned up to about, I think it was 110 or 120K, you could access this low to medium income tax offset. Obviously, it goes down the higher the income that you earn. But if you're in that bracket, it means that you could get up to $1,080 back. It's an offset, so it means that you don't actually get a tax refund of that whole thing back, but it reduces your tax, which essentially means that your tax refund's higher.
Yeah, perfect.
Yeah.
And you know what I'm like, I'm always looking for that, and what does this mean for you? And there it was, right at the end, the 1,080 tax offset. I love it.
Yeah, sounds good.
Look, we're talking about, obviously things that came out in the budget. We're talking about tax time. But there's some really important changes that are actually coming in from the 1st of July. So the first one is, talk to me about tax rates and super.
Okay, cool. So tax rates are going down for small business owners. So if you're running a business through a company, you would have heard that your tax rate was 26% or 27.5%. It's actually gone down to 25% for 1st of July 2021. And if you haven't heard of it, you're basically living under a rock. But it could be because of your structure as well. So that means is that your structure was a trust or a sole trader and you weren't running your business through a company. And as most people would know, if you're running a business through your personal name, your tax could be all the way up to 45%. Whereas when you're running a business through a company, it could be like 25%. So just to explain a bit about structuring of your business for brokers or for your clients, you can structure your business through a company, or you can structure it through a trust or a sole trader. So they're the three alternatives most cases. A sole trader and a trust don't get that benefit of 25% tax. They get the tax rate of who the ultimate beneficiary is, which is the individual, or the sole trader. So sole traders, if you're making a good amount of income, usually you get taxed about 32.5% all the way up to 45%. And why I mean 32.5, some people say, hey, Davey, tax rates could be 0% if you make a low income, or it could be like 19 cents. But general rule of thumb, if you're making the same amount of income as an average income earner in Australia, which is about, $60,000 to $80,000, you're going to be on that 32.5%. And key note is 32.5% is bigger than 25%. So in a company, if you're running the business through a company, 25% is probably the way that you want to go to try to minimize the tax. That means that you should consider the company structure if you haven't yet.
Absolutely. And I guess, sometimes I think there's lots of reasons why sole traders, sort of stop and think about setting up a company, and there's some cost involved, et cetera, et cetera. But what I'm really taking out of that is that it's really important that if you are a solid business and you're operating under a sole trader structure, that small amount of investment and time to set up a company, you're going to get back tenfold in your tax rate. Is that right? Is it as simple, in simple terms, is it that easy?
Yeah. Look, it just costs $1,000 or even $600 to set up a company. It's really, really cheap. And if you're making $100,000 a year, or maybe even 200 grand a year, you could be saving thousands of dollars in taxes.
Yeah.
Yeah. So we have some clients that come to us and they've had this structure for a very long time. And I'm telling you, they could have saved like $50,000 or 100K in taxes if you just set up the structure or change the structure earlier than now. Yeah, it's pretty unfortunate, but it happens. And that's why it's really important to speak to the right accountant. Cool.
Perfect. Now, you mentioned that, the changing in tax rates. So the tax rate's actually dropping again for small businesses, isn't it?
Yeah, dropping to, so it was actually 26% last year. So, sorry, hasn't finished up into, it's not 30 June yet. It's actually still 7th of June. So it's still 26%, but from 1st of July, it's going down to 25%. So a few years back, one of the federal budgets, the government actually said, we're going to try to drop the tax rate for companies. And the reason why is because they want to, I think they're trying to encourage people to run businesses, but they're also trying to encourage people to, use companies rather than using trust. So, notoriously, a lot of people think, setting up a business in a trust, you can minimize the tax. They just, the government's just trying to say, set it up in a company the way it was supposed to be, minimize the tax through a company, which is 25%. And so, by the way, we haven't spoken about super. I forgot about talking about that.
Oh, don't worry. I'm about to leave there because this one really interests me.
Yeah.
So, super's been everywhere. We know that people have been able to access their super to support them during COVID. Lots of people bought boats and caravans and put it in accounts for house deposits. And we know, that conversation has certainly been out in the market for some time. But there's some really big changes to super. First of all, the rate. So talk to me about the increase in rate for compulsory super.
Yeah, so increasing in rate of compulsory super is a good thing. So it's not like tax rates. Increasing the compulsory super, so that's what you're getting from your employers if you're working for someone, or getting that you're paying yourself. So back in the day, it was 9%. Now it's gone to 9.5%. And now from 1st of July onwards, it's going to 10%. So it's not a big change. It's 0.5%. And plus that's 0.5% of your income. It's not that much at all. Could, be $500 or $1,000 a year, or it could be a bit more. But the great thing about it is that you're getting more money and you're essentially getting a 0.5% pay rise.
Yeah, and I imagine that on the admin side for lots of employers, it may not seem like much to us as the end receiver, but I can imagine there's a fair bit of work in that, right?
Yeah, there is, because if you have 10 employees, that means that everyone's getting a small bump in their super, which means that if you're doing a regular payment to your superannuation, to everyone's super on a monthly basis, you have to bump that up by 0.5% each month. And if you have 10 employees and each employee has a different super fund, it means a lot of work. So that's one big thing that you need to think about. Another thing is that there's also a complete abolishment of the threshold for super. So $450 a month. If you paid an employee $450 on a wage, they technically before the federal budget didn't need to have super. They didn't need to be paid super. So that's another thing that's going to be annoying for employers, because employers are now having to, put these people on super, pay their super on a monthly basis, even though it's like a couple of dollars or even $10, $20 they have to put these guys on. So it means more work. But if you're on a good accounting system, Xero, MYB, everything should update seamlessly, and auto super should be already updated and direct debit out of your bank account, so you don't have that trouble. But it's more for those guys that have old accounting systems or doing things manually. That's where it's going to be a lot of admin work.
And I imagine, I'm not sure if you can answer this one for me, Davey, but I imagine that there's going to be down the track some fairly hefty penalisations if you're not paying the right amount of super.
Yeah, so I've been kicking up a storm about this for the last few years. And I think during COVID, the government actually slowed it down. But there was something called single touch payroll that happened 2 years ago. 3 years, in 2017. And single touch payroll is basically, we had to report our pay runs and our pay slips with the tax office as we go. So initially, we only told the tax office on a monthly or quarterly basis how much wages we pay to our employees, and it's the total amount. It wasn't individually how much we pay to each individual, but single touch payroll changed that whole thing. So instead, now the tax office knows how much money is actually hitting the superannuation account for your employees, how much you should be paying your employees, and if the money actually went into the super fund account. If they knew that information, what do you think is going to happen next? They're going to basically find out who's not doing it right, and then audit them, and then cause penalties, interest. I'm telling you, the ATO charges a pretty high interest rate when it comes to superannuation, unpaid super.
Yeah.
Yeah. So you could be looking at even paying a lot of taxes. A lot of superannuation, late payment and penalties. And just so you know, just because you own your own business and you employ yourself and you're not paying your super, it's again, there's still people getting caught out for that. So if you're one of those brokers that paying themselves but don't pay their super, yeah, you're gonna go into a lot of problems if the ATO finds out. And I'm telling you, in the next 12 months, the ATO is going to find out.
Thank you. And I think that's probably a very good point to bring up today. So I'm glad that we did touch on that one.
Yeah.
I certainly know of a few. Your contribution amounts up to 25K, that's changed as well?
Yeah. So what the 25K contribution amount is concessional contributions. So back then, you could contribute up to 25,000. That includes the 9.5% employer contributions. That one there, you would get a tax deduction in your personal name. So you don't pay that 32.5% or 45% tax rate in your personal name. It deducts out of your income and then goes into your super fund and gets taxed at 15%. So that was a great thing about it. But you only were able to contribute up to 25K. So if you're earning, well over 200K or 250K a year, and you had 9.5% employer contributions into your super, you didn't really have much money left over to contribute. So what happened was that I think last year, what the government did was they allowed everyone that was impacted by COVID to take $10,000 tax free out of the super. I think that caused a really vicious cycle, which basically meant that a lot of people in Australia took out their super. I didn't take it out, but I know a lot of my friends and families did. And as a result of that, it really reduced a lot of people's super and retirement funds for when they retire. And I think that made a pretty bad press and caused a lot of problems for the government, because they shouldn't have allowed something like that to happen. I know there were people that really need the money, and I think they shouldn't have made it a lot more stricter for those. So you had to meet certain conditions, but I think it was quite really relaxed. And as a result, a lot of $10,000 were taken out of super. And so now they're trying to beef that back up. And so therefore they increasing the super contributions cap for concessional super to 27.5.
Awesome.
Yeah, cool.
And look, I guess, and I've got one question here already, which is actually a really good one from one of our brokers, John. But just before I touch on that, so just to be clear, if you're self-contributing to your super, you're looking at 15% tax as opposed to that between 30 and 45. Is that what I'm hearing correctly?
Yeah, basically. So you get a reduction of your income in your personal name, and that gets pushed into your super, and then it gets taxed in your super. If you're self-managed super fund, it gets taxed at 15%. If you're industry super fund, they take care of it and they tax it at 15% as well.
Unbelievable. All right. So Johnny's asked us, Davey, can we pay super for ourselves once a year at the end of the financial year?
If you pay yourself once a year, then you can pay your super once a year. So what that means is that it depends on your regular payments and what you lodge with the tax office. The tax office says specifically that you have to minimally pay yourself every 3 months or every quarter. So if you pay yourself at the end of the financial year, then you can, yes, contribute to super once a year. But if you pay yourself regularly every month, that means, you have to contribute to super minimally for every 3 months, if that's a word, minimally. One quick thing that I should tell the brokers out there is that usually superannuation gets paid after the end of the month. So, for example, April super gets April wages get paid first, and then super for April gets paid in May. What I recommend to a lot of brokers out there is to pay your super before 30 June. And usually we say 20 days, 20th of June, pay your super already. And the reason why is that the ATO actually doesn't allow you to claim your super until you've paid it. So usually that June month of super, or that April to June quarter of super that you haven't paid, that doesn't get to claim, that doesn't get to be claimed in this financial year. It gets claimed next financial year. So we tell our clients, pay it before 30 June. And because you pay it before 30 June, you get a claim at this year. And you're going to claim it anyway, and you're going to pay for it. So you might as well claim it this year. The earlier, the better. And also pay on the 20th of June, because as you know, it's super. It takes 10 days or, minimum 10 days for it to go into your super fund.
Perfect. So before we move on to the next sort of dive into super, John, just for your sake, the answer obviously to that question is a no. If you're paying yourself regularly, then you need to be paying your super regularly. And it's probably an offline chat for some of you brokers out there. So really happy to be able to do a bit of an intro, and you can have a bit of a chat to Davey more one-on-one. There may be a few people out there scratching their head saying, how do I rectify this?
Yeah.
Yes, I'm paying myself monthly, but I'm not paying any super. So yeah, let's definitely take that one offline, but it's a really big one for our broker family to note, is if you are paying yourself regularly, then you do need to be paying your super regularly. And I guess if you get into trouble with things with your super, Davey, what's the best? We all know that burying your head in the sand is not the best course of action. So is it better to sort of go and speak to someone and say, hey, I don't think I've been doing the wrong thing, and rectify it? What's your suggestion there?
Yeah, so you've got to work out how much super you haven't paid. Well, it depends firstly on who have you not paid firstly. So if you have not paid your own super, or you haven't paid your employee super. If you haven't paid your employee super, then do it as soon as possible. Because if you don't rectify this issue, the ATO has actually been a lot more harder on people that haven't paid the employee super. It's essentially, you're stealing money from your employees, and now the penalty is a lot more harsher. So they go after the directors personally. So yes, I know if you set up a company, you're protected under the Corporations Act. So therefore, if the company goes down, you don't personally get liable. Unfortunately, the government says that they can go after you personally if you don't pay your employees taxes and super. And so the first thing you need to do is speak to an accountant, work out how much unpaid super there is, and then figure out a way, maybe borrow the money to pay the super as soon as possible. Get your taxes lodged up to date as well, because if you don't lodge your taxes up to date, there's a rule out there that they can go after you personally as well. So make sure you lodge your BASs on time. The next thing is then if it's for yourself personally, then I think you need to work out how much super you need to put into super, and then you lodge a super charge statement. That's what they call it, a super charge statement. Unfortunately, you have to lodge it every quarter. I don't know why there isn't a better way of doing it. You need to work out how much super that has been unpaid for each quarter that you haven't paid, and then lodge that statement in, and the tax office is going to charge interest on it. Put it into your super, and also charge a bit of admin fees as well. But it's better to do it now than later. I'm telling you, this is your money. This is your nest egg. And the clients that come on board with me that haven't dealt with their super for 50 or 30 years or their whole life, they're really paying for it now. So I'm talking about they're paying taxes constantly on their investments at 30% to 45%. Whereas if they was in their super fund, they would pay 0% tax when they retire. And it's really unfortunate. Like, you really need to think about it. Even me, like, I regret not looking at my super when I was 18. I started looking at my super when I was 25, and I still regret the last 5 years of, or 7 years, 18 to 25, that I didn't look into it. It could be so much more bigger. Yeah.
Yeah, absolutely. And look, I think the main thing here is that, yes, if you're an employee, then these benefits are all here to support you and support your long-term wealth. And for employers, it's just really important to be doing the right thing. And that doesn't not only just mean looking after your staff and making sure that you're adhering to all your regulatory and legislative requirements, but also looking after your own future. So yes, you might be doing all the right thing by your employees, but remember that you need to plan for your own future as well. Hey, look, let's move on because we can talk about super all day. Obviously, we said we know there's been a big focus, and typically the reason why it's been such a big focus is this, 10K cash out, which, to a standard couple could have been 40K in a very short amount of time, which is a huge burden on your super. Talk to me about what this means to someone's super.
So it's hard to say because I'm not a financial planner. I did do the maths before. If you take out that 10K, it could mean 100K in 20 to 30 years time. But definitely speak to a financial planner to make sure they can do the calculation for you. But it's excessive. And then as a result of that, when you do decide to retire, what happens is that your super, the tax rate that you're paying, the 15%, goes to 0%. So you're not paying any more taxes after you retire on that nest egg that you've made. So if you've made $500,000 or $1 million in your superannuation fund, that money that you have in there now, if it's invested at 8% per year, you could be making 80K tax free. That's the beauty of it. So whatever you're earning right now, like let's say it's about 80, 100, or maybe even 200K, you're paying taxes of 30% to 45%. Whereas when you do decide to retire, you pay 0% tax. And the reason why the government does this is because if you weren't earning any money in your retirement, that means that they have to give you the age pension. That means that it costs them more money in healthcare, your personal spending, your rent or your mortgage or whatever it is that you have. So it costs them a lot of more money. So they're trying to give you a tax incentive is, save money for your retirement. And as a result of that, then we won't tax you.
So let's say, the takeaway is super equals passive income, right?
Yeah, pretty much. Yeah. So, I'm like, I won't disclose my age, but I'm about 30s and I'm thinking about super more than ever because the tax incentives are just amazing out there. And then there's talk about self-managed super funds as well, where you can manage your own investments. Most of the time when you do make money, what are you going to do with that money? You're going to invest it or you're going to do something with it. And the tax incentives in super is amazing. Again, of course, speak to a financial planner, but it's good to think about, using that money in super to invest rather than, doing it all in your personal name.
Perfect. So look, let's have a little bit of a shift, Davey, because we certainly know that a lot of brokers have really reflected over the last few years with, the RC and then COVID, and, it's been a pretty hefty 3 or 4 years for the industry.
Mm-hmm.
If we've got brokers that are sort of looking to sell their loan book, and I guess this advice can come for brokers too, who their clients may be looking to sell their business. But obviously they really need to consider these small business CGT concessions that can reduce, the tax or on the sale to nil. Now, that question makes me sound like I know what I'm talking about, but I don't. So I'd really like to hand over, this CGT discussion to you because I think it's really super important.
Yeah, this is great. This gets me excited because so the way let me bring it back a bit. The way capital gains works and CGT. So you're thinking like what's a loan book got to do with CGT and capital gains tax? Because usually it's to do with property. So when you sell asset, you make a profit on the asset, you have to pay tax on it. And if you own the asset in your personal name, you pay the marginal tax rate of 45%. But if you've owned the asset for more than 12 months, you get a 50% discount. So therefore your tax rate at the end of the day is about 22.5%. So that's how that capital gains work. So how does that work with your loan book or your business? It's the same thing essentially. So your business is an asset as well. So when you do sell your business, for example, we've had actually a lot of clients in the last 5 years sold their loan book. And the reason being it was not because they wanted to, it's because they had to. There was a bit of issues with the contracts, or one of the big banks said, look, we want to buy back the business because we want to take it in-house. So they had to be forced into the sale. They could have kept trying doing what they did, but then they wouldn't have got the deals that they got from the big banks. So they had to sell back. So what happened is they sold their loan book for $1 million, $2 million, or $3 million. And they initially put in $0 for their business. So therefore, their profit on that sale is $1 million, $2 million, or $3 million. So as a result, if we did the capital gains tax calculation that we just did before, $1 million, let's just assume it's $1 million, times 45% is a lot of money. They get a 50% discount because they've held the business for 12 months. So they're paying about 22.5% of that $1 million. That's $225,000 in taxes for that $1 million. So you're losing, look, it's not that big of a tax rate, but you're still losing a lot of money. That's where the government came in a few years back, and they implemented this thing called the small business CGT concessions. So the way small business CGT concessions work is that we know, the government knows that this money is a retirement. It's for your retirement. It's for your nest egg. So we're trying to encourage you to have money for your nest egg. So we don't want to tax it. And we know sometimes that you don't put money into super because we're old school. We want to inject that money back into the business. So therefore, they say that as long as you put that money into super, we can reduce your taxes on that 225K. So look, this CGT concession, there's a few eligibility requirements. Speak to an accountant and how it works. But generally, if you're turning over a business that's under $2 million, so if your loan book is under 2 mil, if your asset level is under 6 mil, one or the other, it doesn't have to be both. So under 2 mil turnover or under 6 mil net asset, then you can be eligible for this CGT concession. And as a result, you can get a further reduction of your 22.5% to 10%. Or if you want to keep it to 0%, you just need to put that money into super. So I've done the maths. $1 million, $225 million tax. From that 225, you can drop it down to about 100K. And from that 100K, you can just pay the tax on the 100K. And then that's good. That's like a 10% tax. But if you really, really don't want to put any money, give any money to the government, you can legally put that money into super and pay 0% tax. So we've actually had clients put money into that money into super, then get the superannuation fund, set up a self-managed super fund, and then invest with that super. So they ended up paying 0% tax on that $1 million sale of their loan book. It's amazing. Wow. Yeah, it was so amazing.
That's really interesting because I guess I just wanted to go back to super for a minute because we've got another question from Mark, and what you've just spoke about then makes a little bit of sense, is that, what's better for the individual if they've got excess income? Is it paying off your mortgage quicker or putting it into your super?
Well, the mortgage is, it depends because the interest rate's so low. And I'm really sure most of the brokers out there will know that, that's like, you can only get that much leverage and that much money from the bank on your mortgage. You can't get that in your super fund. So like I always tell our clients, and I know this is like a bit financial planning, so I'll throw it back onto our clients and say, think about it this way. Your property or your mortgage is paying 2% interest rate, right? And your super fund, if you just stuck it in an industry super fund, how much are they getting on average for you in returns? 8%. So that's the thing that's different. Like you're paying off a 2% interest rate, whereas where you can put that into a investment that's getting you 8%. I don't understand why you would do that, unless like there are some clients out there that are low risk. They just say to me, Davey, I just want to pay off my interest, pay off my loan, and just not worry about loans moving forward. I just want to be loan free. And that's great. Like I think that's a good thing for a lot of clients out there if they want that. But there are some clients that just want to go invest the money, earn passive income or earn extra money that would then fund their lifestyle. Yeah. So it just depends on them. Yeah.
Yeah, correct. And again, which is going back to this conversation about, the more you leverage relationships, so your broker, your accountant, your financial planner, all of these people can work, together to make sure that you're getting the best solution. And look, Philip, who's on today as well, he just said, zero tax sounds really good after spending years and years and years to build up a good loan book, right? So knowing to put that into a self-managed super fund, I don't know how many people on our webinar knew that today. But these are the small insights that by working with professionals in our industry, you can get some great advantages. So, for anyone out there who's looking to sell a trail book or a loan book, make sure that you're doing it in conjunction with your accountant. I think that that is really, really important. And you're right, a lot of people think their loan book is like their super. So when they are looking to retire, it's really important to know what they're gonna do with that extra income. So Davey, I want to move on to identifying opportunities for our brokers. So really drilling down into what actually it means for them. I've got sort of 4 or 5 headings and I'm going to throw them out to you. Let's talk about being proactive first.
Okay, so being proactive for me for a broker. So I have a few a few clients that are in the finance and loan space, and I think that the proactiveness in them, I can see which one is good and which one isn't. And the ones that are proactive are, talking to their clients and learning more about their business. They know their client's business throughout, so they know how much they're making. They know what type of assets they need. They know what type of loans they need when. Or when, like currently, or when they need it in the future. So that's the beauty of those, good brokers out there. They also contact their accountants. So they have a good relationship with all their clients' accountants, and having a good relationship takes time to build. You don't just get that just by having a coffee with one accountant. Look, man, accountants are a different breed. It takes a bit of time to build a relationship with accountants. We're not very trustworthy. We're tight asses. We don't like talking. And so as a result, you need to make sure that you build that relationship slowly. We get a bit nervous when we see too much people. We like to be in front of our computers. Yeah. So
you're obviously one out of the box, mate. One out.
Well, I've been doing this for like 14 years now, so I've kind of changed a bit over time. But yeah, I used to be one of those accountants that barely spoke to many brokers or accountants. Other accountants. So yeah, Philip was saying, try to change the image. Yeah, so it's important to change the image of not just like me as an accountant, but it's also important for brokers to go out there and speak to not just the client but the accountants as well. So an easy way to do this is like providing the information the accountant needs. So like the accountant needs the loan documents and schedules, amortization schedules. Get in front of the client and ask for the client's accountant's details, and just say, hey, I just want to throw this information to the accountant. And so you can get the details, send them an email, and just say, hey, if you'd like a chat for a cup of coffee or whatever, or just a phone call, we're one call away. And that's the first point of contact that you should make. And then over time, just keep, speaking to the accountant on a regular basis. Not obviously every week, but, every 2 to 3 months. That's important. Yeah.
I think it's really important, and it's that real holistic solution. So, certainly in my game, we talk about don't focus on the cost, the rate, focus on the cost of the solution. And so I think this holistic approach really leads to building stronger wealth communities, not just for our brokers and their own business, but for their businesses that they support. And we're seeing a lot of brokers really now starting to want to understand their client's business more. And it's not just where can I go and get them 100K and how quickly, really trying to sort of fill that advisory piece when it comes to, what finance they're getting and why they need to get it.
Yeah, I agree. Like, I always tell my clients, and because I work with a lot of clients in the professional services industry, so we service clients a lot, and I say to them that it's all about waiting for the right opportunity, and you just need to be ready. So I think a thing with accountants is that they have a few brokers already, but there'll be times where, especially this current period where everyone's busy. Property market's going off. People are trying to buy assets. People are looking for assets to purchase. They're trying to borrow money. So therefore, there's going to be a time where I don't have any brokers that that can speak to my client right now. So therefore, I'll just go to a new broker that I've spoken to or had a cup of coffee with last week, and refer him, and then, see how that works for the first week or two. And then if that works well, then we start referring more clients to that broker.
Perfect. And look, guys, certainly I know from me spending the last month working with Davey, you can really use your accountant relationships and leverage those to just organically increase your own financial literacy, which is a win for everyone. So I sort of can't recommend that more. Let's talk about best practice now, Davey. So, we know that there's a lot of common mistakes. Talk to me about some of those.
Yeah, so there's common mistakes on different parties. So obviously the broker can have common mistakes. Some brokers are thinking about getting the cheapest rate. Some brokers are thinking about just getting solving the solution, but not thinking about anything else. Or they just miscommunicate or don't talk to the connected parties. So I'm talking about the client or an accountant. And then you got clients. Obviously, the client comes first. Everything to do with the client is most important overall. But the problem is that some brokers don't speak to the client and get the right answers answered first, or the right questions answered first. So what I mean by that is the broker could be thinking about getting the cheapest rate, whereas the client sometimes need this deal done within 7 days. So for them, the solution with the fastest outcome is the most important, right? And then the accountant, we've got this guy here thinking about minimizing tax. That's all we care about. So we're just going to delay the whole thing just to make sure that we'll work out tax strategy to minimize tax. So we've got 3 different parties wanting 3 different things. A broker that wants the cheapest cheapest interest rate, an accountant that wants to minimize tax, and a client that just wants the solution done within 7 days. And that's where we have this really, really bad relationship that we're building, as well as this bad planning. And as a result, it gets delayed. Broker starts blaming the accountant for delaying, taking too long to try to work out this tax strategy, or not even picking up phone calls. And the accountants blame the broker, saying that he's looking for the cheapest rate, whereas the client just wants the deal done as quick as possible. So I think the most important thing is sit everyone in a room or via phone call and talk to each other and align the objectives. Oh, sorry, Danielle, you're on mute.
I muted so that I wasn't coughing and I forgot to unmute. And I think it's really important. And one of our great lending partners that we have, Cameron Garnham, he talks about, this solution type stuff. And if you've got someone who typically imports goods from overseas, they've got the opportunity to buy a container at, half price. So we'll just throw some random numbers out there to make it work, but they can buy 300 Ks worth of stock for, let's say, 180 grand. Because it's being left, at the wharf, at the docks. But they need to do that in 3 to 4 days. So if that transaction is going to cost them, 10 or 15 grand, so that stock now costs them, say, 200, but the sale opportunity on that is still 400, 450 plus, then who's not going to want to do that deal? It's not always about rate, it's about solution. And so I really like that. And again, we keep touching on this. It's why it's really important for professionals all to work together, accountants, brokers, lenders, your client, because it should all be about the solution and not necessarily, the rate. So I like that.
Yeah.
Opportunity. Let's talk about what opportunities, all of those things, by being proactive and offering best practice in your own business. What opportunities does that then create?
Well, the opportunities is that you collaborate more, right? So obviously when you start removing the barriers of, communication, there's going to be a lot more talking with the brokers, finding the better products out there, speaking to good accountants out there that do the referrals. Look, I'm telling you, once I speak to a broker and I find out this broker that can do this deal, then the next thing is this client comes on board and says, hey, I need to go get asset finance, or I need to buy a car. Then I'll be referring this straight to that broker as well. So I think the key is the opportunity comes from the relationships you build, and getting in front of the client and getting in front of the accountant, talking to them face to face, solving their problems is what's going to get you more referrals.
Yeah. And look, you and I spoke about this when we caught up about this webinar as well, is not just looking at the here and now, like looking at what you can do for your client in the next 12 to 24 months. What are your thoughts on that, Davey?
Yeah, of course. And I mentioned that at the start, which is like, don't think about just the current finances that you have. Think about what the future holds as well. So I speak to my clients when I onboard a new client. I always ask them that question: what's your goals in life? And like whether it's family, investments, or like just a flexible lifestyle. And then from there, I work out the different stages of their life and where they're at, because it's really easy. Like once you know those three different types of personalities, whether they just want to make a lot of money, invest it, or they just want to provide for their family, or they just want a flexible lifestyle where they just don't work that much, and they can just take their weekends off, or work 9 to 5. That's where you can work out what when they need the finances, what type of assets they need to purchase, and that's where you can give them proper advice, because you can speak to the accountant and say, hey, XYZ client wants to borrow in the next 12 months. We need to make sure that they can achieve the outcome of borrowing. So therefore they need their numbers to be good. So we're not doing anything dodgy out here. We're just telling the client upfront, this is what you need to show. This is how much you need to make so you can get that loan and, provide for your family or buy a house. Or buy an asset. So it's really important to get in front of the clients and speak to them about, what their goals are for the next 12 to 24 months.
Perfect. So I just want to wrap up this section before we sort of spend the last 10 minutes on either just a bit of Q&A, but also how to get the conversation started as we head into the doom of the last 3 weeks of the end of financial year. So we know that some of these examples of best practices where we can be working with other professionals to get the best outcome. We've got real estate agents, accountants, finance brokers like our guys that are here today, lawyers. But one of the things, Davey, that was really important to me, and I laughed when we spoke about it, was when you're wanting to leverage other professionals, take your time and be patient. And I think what you said to me was, just because you take me out for one cup of coffee doesn't mean you're going to get business off me.
No, I didn't say that. I said, I'm not going to marry you. So someone told me that just because you take out a coffee with me doesn't mean I'm going to marry you, because
it's that first date analogy, right?
Yeah, no, exactly. So like it takes time. And like I said, like accountants and lawyers, not real estate agents, they're pretty, they're pretty out there, but accountants and lawyers don't like speaking to people. So it takes time for us to build a relationship. So, and I'm telling you, like 4 years ago, when I met up with this high flying lawyer, I had a lunch with him, and he kind of flicked me off for a couple of years. And then after 2 years, now he's my best referrer. He refers me all his clients, and he loves what I do, and he trusts me, as well as he thinks I'm really good compared to accountants out there. And it took me 2 years to build that relationship. I'm telling you guys, it took me 2 years. He just thought I was just a small fry out there, and I literally was. But it took me 2 years to build that relationship, and now that I have this relationship, we're like best mates. I went to his bucks, and I would have been invited to his wedding, but because of COVID, I wasn't.
Yeah. And look, it just really speaks to that value of persistence, right? Does the guy, get remembered who goes out 1 in every 20 bats and hits a home run? Or is it the guy that goes out, and hits 9 or 10 out of every 20 bats, and gets everyone else home? So I think it's, really important to again understand, stop expecting everything today. It's like we're living, an 18 or a 19-year-old life, and it's really important. That value of relationships is unbelievable. So, okay, how we get the conversation started, we have got a couple of questions. So I'm wary of just trying to run this section quite short, Davey, for about 5 minutes. But how do, as a broker, how do we get involved with our clients about end of financial year conversations?
Yeah, well, first things first, it depends on your personality. So are you a person that, likes to speak on the phone? Are you a person that likes to talk face to face? Or do you want to do email? So it can be direct or indirect. It just depends on you. And there are accountants and brokers and lawyers and real estate agents that do vice versa as well. So for you, just target what you're good at. If you like being on the phone, then be on the phone. Again, it's about building relationships. So it takes time. Be patient. I hate it when I hear, clients and friends and families that just go and spend 1 or 2 months to do what, or 3 months of doing, cold emails or, calls or social events, and then just give up. It takes time. Like if people see me do my videos, I've spent 2 years building my videos. I've been consistently every week releasing videos every week for the last 24 months. And now it's starting to get noticed, like hence why I'm here. But it took me 24 months to get there. And now we're starting to get noticed. And, if you're thinking that you've spent 2 to 3 months just calling people or, being face to face or going into social events, like you're dreaming that you can make a lot of money in the next 3 months. So you need to take your time and be patient. Exactly what you said. Cool.
Perfect.
Yeah.
So probably the other one is just around case studies to encourage conversations. I think it's really important that brokers draw on other experiences that they've had, rather than coming from always, well, not always. The advisory brokers always seem to have that, hey, I've been here before, I've seen this before.
Yep.
This is how we've handled it before, rather than sort of a dictatory, we need to do this. Now, some clients need that, and we all understand that. But, what is maybe one sentence that you would encourage brokers to use to start a conversation with their client?
Well, invest in content. That's what I did 24 months ago. And so what I mean by that is, start providing value, start providing educational videos, because there's going to be that one accountant or that one client that has a problem, and they're going to watch your video, your read your article, or see you on Google, and then just digest all that information that you have. And they may not they may not buy your or build a relationship with you straight away, but they start earning that trust, and then they start like knowing who you are, and then eventually they're going to start referring, or they're going to start talking to you. So I think the main thing for to answer that question is, start looking at all those case studies that you have, those examples of what you've done to help other clients, and then invest in content to provide that information. Yeah.
And so I guess if we look at, EFS, conversation starters, we want to talk about prepayments, yeah?
Yeah. So for example, I released a video this end of financial year talking about, all these tax tips, but I know brokers can do the exact same. They end of financial year, what do clients do most of the time? They buy cars, they buy assets, they try to minimize their tax. Brokers can release content regarding not the tax consequences, but how to structure your loans, or what type of products are out there. What are the issues that you will face when purchasing or borrowing money, and what do you need to provide to accountants out there? So I just came up with 5 topics just like that, or 4 topics that just like that. I'm sure you guys can too.
Absolutely. And you're right. And because that was going to be my point again, if we're looking at those sort of conversation starters to one, connect with their clients, and obviously write business leading up until the end of financial year, is being able to have those conversations, being understanding about the asset write-off, understanding about, the CGT concessions. There's really value, and our brokers don't need to be the experts, because that's you, Davey. But what they need to be able to do is feel comfortable to have the conversation, because it builds trust with their client, but it also builds trust in the fact that they're knowledgeable and they've got an understanding of the things that actually can have an effect or an implication on the type of finance or the tax for the business.
Yeah, I totally agree. Like, there are so many times where a client, deals with a lawyer or deals with an accountant, and then the accountant says, "Yep, speak to a broker or a mortgage broker or the bank," and you're off on your own. So I hate that relationship. Like, you should be focused on like collaborating with other partners out there, and brokers should be thinking about that too.
Yeah, perfect. And look, it's the same. You and I both spend a fair bit of time on social. And that's not all it's about. It's getting the message out there so that you're tapping into an audience or to people that you may not normally be able to access, but then it's maintaining that relationship. And as you said, it's not about ringing someone once a week, but it's about maintaining the relationship. There's no point in putting up social, content and then you're nowhere for 3 months.
Yeah.
It's really about that sort of strict, but always out there in the eye type of communication. So look, consistency is the key. Having conversations, leveraging relationships. What I'd really like to do now is just quickly go to our Q&A session. One of the comments that actually came through before, which I found really interesting, was around, and it was probably more commentary than a question, Davey, but, make sure that your home loan, refi if you need to. Make sure your home loan's on the best rate, and then salary sacrifice your savings into your super, yeah?
Yeah, that's the common strategy that people do, which is like get the cheapest interest rate, put it into super, and then get a good rate of return in your superannuation. A lot of people think about self-managed super funds, but just be careful with self-managed super funds as well, because the cost in self-managed super fund is quite expensive, and it's not the right thing to do. And again, speak to a financial planner to get the advice. But self-managed super funds admin cost is quite high, so you got to make sure that you have enough money in there to warrant the cost involved. So the benefit outweighs the cost. But yes, that's a very good strategy. It's a strategy I personally do as well. So I keep my interest rate quite low as possible, and I invest using my super fund. Yeah,
perfect.
Mm-hmm.
Team, we've got about 3 minutes. So are there any, yep, we've got one here. Yeah, so Phil's just said about, the more members you get into the SMSF.
Yeah,
better.
Yeah, the better, because your fund balance is higher. But you got to be careful of that, because we've had cases where members go, members between, you could have brothers and sisters in your self-managed super fund. But the problem of having that is that, things change, right? Like you get married and you want to have a retirement fund with your family. You have goals of setting up your family and your kids. So therefore you need to kind of exit out of the super fund. And that caused a lot of issues, because when you invest with that super fund and you buy assets, making that sale would result to a lot of capital gains tax and admin costs as well. So you got to be careful. Yeah. Adding members is great, but then you guys have to have a aligned goal together, because, if it's not a 5 to 10, it's not 10 plus years goal, then you shouldn't really be going, adding members together just to increase the funds, because, 5 years down track, you might just sell. Yeah.
Yeah. And Phil, you're right. Discipline between members is important, and there is a lot of trust, and for every story that you do hear that's a little bit negative, I'm sure there's 2 or 3 positive ones. But you're absolutely right, Davey, and it's all about what the parties come in with. Do they come in with equal amounts to start with, so then they can leave with equal amounts, or is someone loaded up with more super than the other? So yeah, it's definitely a conversation to have with some very trusted advisors. So Davey, last time we did this, we didn't take the hour. I think we've done a really good job today, and we've actually, kept all of our attendees for the whole session. So again, it's always just such a pleasure to talk to. I'm sure that you've heard, the stigma that sits around our accountant friends, and it's just really nice to be able to have technical conversations that are really important, but in a way that's easy to understand. And so, I really appreciate you for that, and I'm appreciating this series. So before I sign out, is there anything that you would like to leave our brokers with?
No, just keep on making money for our clients and letting them finance their dreams, because I think without you guys, we can't do what we can for our clients. So thank you very much. Like I think I work with a lot of brokers out there, and there's a lot of good ones out there that really care about their clients, and they help their clients get what they want. And there's a lot of people out there that don't, think that you guys do a really good job. I actually personally think that one of you guys are the most important people out there. It's really important, because there's clients out there that literally don't understand a single thing when it comes to borrowing money. And so they, borrow with a high interest rate, or they just get the worst deal out there. And there's people like you that help our clients get the best deal and save them thousands in taxes. The thousands in interest rates, right? Whereas then there's people like me that try to save clients in taxes. So thank you very much. I don't know if your clients thank you enough, but I for sure thank all of you guys, because you guys do a really great job.
Excellent. Now, for those in WA, return to your public holiday. A few of you have actually joined us on your public holiday, so thank you very much. A couple of people have asked where they can find your media content, Davey. Now, I'm assuming that's Davey Mack handle on LinkedIn,
Yep.
but also YouTube.
Yeah, YouTube as well.
Yep. So, and that's MACH, guys. So, Davey Mack. So you can jump on, follow him on LinkedIn. You'll also find his videos on YouTube. But this is not the last that you will see of Davey Mack on LNDD, our small business accounting webinar series. Have an awesome week and tune in July, guys. See you soon.
See you guys.